Hello, everybody. Adam Parks here with another episode of Receivables Podcast. Today, I'm here with my good friend and industry legend, Mr. Larry Costa with Capital Management Services, here to talk to us today about diversification. And as the debt collection industry has continued to face challenges on the regulatory, technology, and other fronts as we've converted from a debt collection industry to a customer service first related industry, Larry's been very far on the forefront of thinking through these diversification options and modifying his business from a collection agency to a call center, I think is a great way to put that. But Larry, thank you so much for joining me today and sharing your insights.
It's always a pleasure to talk to you, Adam. It's a privilege to talk to you, Adam, because you really are at the pulse of what's going on in the industry. And I appreciate the kind words, but you and I have had this conversation for many years. To really insulate yourself from any kind of economic disruptions, you have to adopt a diversification strategy. It's necessary. And we've been doing this for many, many years, and it's worked out really well for us. So one of the things that, as we go through this evolutionary process, is as a third-party collection agency, either principal or higher level executive, you got to start thinking about what you do, right? And that's how we started. So we said to ourselves, what do? We do collections. Who do we do collections? We do collections for banks. Well, what other products do banks have? Well, they have mortgages. They have customer service. They have all kinds of issues with fraud. They have many, many issues. They have loan verification. They have all these different functions that they do as a bank. And so what we did is we started to contact our banking clients saying, okay, we have expertise in part of your business. What else can we do for you? Because we're already an approved vendor, so you don't have to go through the RFP process. So we started to say, what else we can do for you? And from that, I'm just going to read off a list of some of the things that we were able to accomplish. Is that the natural was first-party collections, which I've talked to you guys about several times in past podcasts. Mortgage customer service, first-party mortgage collections, loss mitigation, right within the mortgage. And I'll talk about how this worked within the mortgage framework, loss mitigation, checking and savings customer service, credit card activation and credit card customer service, loan verification, okay, after hours calling. And then the other thing I said to myself is I looked at my different vendors. I said, well, who do we get health insurance from? So I contacted a local vendor, right? Because what happens every year to the health insurance providers, they have to go through what's called a Medicare sign-up. Because when you buy Medicare, and typically you have to buy a supplemental plan, you go to your insurance provider to do that. And they have these outbound campaigns and inbound campaigns, and they need people. So what I decided to do is partnering with these guys. Say, look, you're selling me insurance. We're already business partners. You're going to need 30 to 50 people every year from end of September until middle of December. You don't want to go out and hire those people. I've got people who already have skill sets in terms of inbound calls, outbound calls, overcoming objections, all the things that you do in collections. We can do that work for you. So we were successful there. So these are things you got to start thinking about. Benefit change is the same thing. Really, what you really want to do is go to your client and say, look, I can be your one-stop shop, but let's take it a department at a time. And as you build your skill set and build your confidence, that's how you grow your business. I don't mean to ramble here, but so what happens now is that 44% of my revenue comes from these customer service first-party revenue streams. But the more important thing is 70% of my employees are in this field. So what I'm doing,
70% of your employees are.
So what you're doing here is you're taking, right? And Adam's going to help me out here, and I want to just throw this back to Adam. Then I'll discuss what digital means. As we get more and more digital, the reality is we need less and less collection agents. And so I migrate these people with the skill set into these first-party projects. So not only do I increase my revenue base, I preserve my employee base, and I get more revenue on the third-party side with less people, and I can increase my revenue on the first-party side because that's where I need people. So Adam, let's talk a little bit about digital, and then we'll come back to this discussion.
So there's so much to unpack there, Larry. I didn't really pick up on how big the need for diversification was until we were executing on the 2024 TransUnion Debt Collection Industry Survey and looking at the diversification strategies of debt buyers versus collection agencies versus law firms versus BPO services, etc. And it became, like, you and I have been talking about migrating to first-party services for some time. And then we did a webinar at the end of last year where we really dug into how debt collection has become a customer service focused
Absolutely.
business, right? And to have a creditor on there really focused on, hey, look, performance is not my primary objective anymore. The user experience, my customer's experience, whether I'm going to bring that customer back in or not, the experience that we're able to provide them, even through distress and in post charge off, is a primary factor that they're focused on. So it's interesting to see how far out in front of these you've gotten, but the paths that you've taken to achieve that diversification is really incredible. That I never really considered the healthcare angle, or the fact that so many of those types of organizations, right? So you've got that seasonal need, and then you've got a seasonal need from the accounting services that really need people from, let's call it January to May, to get the scheduling and things done for people to come in and get their taxes filed, which also ties quite nicely into kind of the debt collection world as well. But I had not really considered all of those cyclical moves from a call center need standpoint and being able to supply that. Now, you talked about how I think it's 44% of the revenue is coming from these services now, and it's become about 72% of your staffing needs. So
Absolutely.
clearly there's a stronger staffing requirement. But what's the most expensive thing in any of our businesses? The people. Hiring, training, recruiting, like getting these people through the door, teaching these people a craft, not just a job, but teaching them a career skill and a craft. And then you have to, like, rather than letting them go as you've shifted into digital, you found new and interesting ways to engage those employees so that they can add value to the organization and you can add value to more organizations. Now, with the shift to digital here, and how you've kind of talked to me about how your organization at the debt collection side of the business has leveraged digital and how that changed your staffing needs.
Yeah, and we're not unique here. Everybody I talk to in the industry, look, we're all texting, we're all emailing, we're all looking at some type of after-hour chat bots, right, to handle people who just want to make payments. So the need for, there's this term in the industry called ACR, right, account to collector ratio, where it used to be, I don't know, and depending on the due stage, anywhere from 300 to 1,000. Now with digital, your ACR requirements in the thousands. So you don't need the amount of staff. Secondly, with all the different dialing and texting, it's mostly inbound work because, we're sending the text out, we're sending the email out, we're having them self-service. When they don't want to self-service, they're calling in. So your collectors are much more productive because they're spending their time on true contacts. They're not spending their time doing senseless dialing or, we do transfer on connection. So your people are more productive. They're spending time with the consumer and they're making more money. It's really, but again, at the end of the day, all of us want to do as much as we can digitally because that's how the consumer wants to be treated, by the way. They want to reply to a text. They want to reply to an email. They want to go on the website and try to negotiate their own payment arrangements. Okay. That's how they want to be treated. So again, instead of having a career endpoint for these people, we're going to continue to deploy digital. We're still going to make phone calls and we're still going to have people on staff to answer questions. But now these people have a new career opportunity and it's a less stressful career opportunity. So, I mean, first party collections, customer service type of work, it's a less stressful. We've expanded. We do after hours calling for banks. And you go back to your bank, say, hey, look, what do you do from 8 o'clock at night till 6 o'clock in the morning? Or why do you want to open your call center at 6 a.m. Have people come 6 a.m. Have them come in at 8. We'll handle your calls from 8 at night to 8 in the morning. Again, and the banks appreciate that. And by the way, you can bill at a pretty good premium. The margin on overnight activity is pretty substantial. So again, that's what we talked about earlier. You've already got the skill set there. You already got agents that know how to handle inbound calls, know how to make inbound calls, know how to deal with objections. And because the collection industry has changed, know how to be empathetic. You move that skill set into more of the customer care world. So you redeploy people, you give them a long-term career. The people that want to stay in third-party collections have greater earning opportunity because they're only handling calls, from people that want to talk to them versus being stuck on a dialer all day long. So it's working out pretty well. But it's still going to change. Adam, you're more on the pulse of this. There's AI, which we're all struggling with. What's that going to do? Are we going to have the true virtual agent? I don't know. What's your opinion, Adam?
That's a really good question. Are we ever going to have the truly virtual agent? And I think right now what I'm starting to see from a technology standpoint is that you'd mentioned everybody can send out a text message, everybody can send out an email, but not everyone can send out the right text message, the right email, the right communication, the right content for that communication at the right time. And I think the differentiator 3 years ago was, can you send digital communications or not? And now the differentiator has become your strategies. So what strategies are you actively deploying? What's your content library look like? And how are you able to marry together the strategy and the content that's outbounding? And that's where I see the differentiator happening. Is you were talking about the account to collector ratio dropping, but the profitability of an individual rising. I find that to be, I hadn't really considered that before, but as we've gone to digital and you can actually manage more accounts with the same person, right? So that's the first piece. But now that person who's handling those more accounts isn't just about managing volume, it's about managing quality. And if they're able to actively collect more because they're spending more time engaging with a right party contact than they are chasing a right party contact and having to skip and try and find that person. But I think as we've instituted more data and we've brought more data into the methodology, we've been able to improve those contacts from a digital standpoint. And if your digital strategy is truly differentiated as an organization, then it really would free up a significant amount of time. And it sounds like you're using less than 50% of the people, but it's now driving almost 50% of your results. Now, customer service takes longer and is priced differently than debt collection.
Absolutely.
And I think it's interesting to see how that migration has happened across your organization, because you've been at this for a considerable period of time. I want to say it's been 10 years now that you've been looking into the future and saying, we're going to need to evolve as an organization in order for us to be able to continue the sustained growth that we're looking for. And I think a lot of organizations are just getting to that point in the last 12 to 18 months. One of the challenges that they're facing is the rise in the volume of accounts and the decrease in the liquidity of those accounts simultaneously. So we're being forced to do more with less from a debt collection standpoint. And 10 years ago, the solution to that would be throw bodies at the problem, right? Throw people at the problem. We're going to dial more. We're going to talk more, right? It was always, I'm going to say, a brute force solution to the on the phone problem. But that's no longer, not only is that not the case anymore, it doesn't work.
Doesn't
Because
work at all.
I could tell you, right, like since we've been on the phone here, Larry, I've had 4 spam calls that have come through to my phone that I can see are happening right here. All 4 of them have been blocked by RoboKiller.
Right. You're going to engage on your terms, right? You're going to engage on your terms. You get the text, you might go to the site. Okay, fine. Maybe register, and then you'll do it on your terms. It's the same thing with email, right? And you have the ability to opt out. And once you're opt out, you're not going to get another text or you're not going to get another email. So it really gives you more of a sense of control. And that's what we're seeing in the consumer. What you're getting back to the point you're making is that, right, we are going to get more volume. But, we really haven't got the huge volume increases that everybody was talking about, but we're getting some more volume. But we're handling it digitally. We're using technology. Everybody is. It's not just us. Everybody's using technology. Look, we still need an agent. There's a lot of digital-only collection agencies that have not seen the success that they thought they were going to receive, because you still need an agent that's trained. You still need an agent that can only hand executives. You still need an agent that can offer settlement programs. A lot of what we're seeing now is settlement over time. So a person knows $6,000. They don't have it. They're not going to the 401k, but maybe they can do a $3,500 settlement over 3 years. So now you're looking at what, $100 a month? People can understand that. People say, hey, now I got a way out. I can't get to the 6,000. I can get to 3,500, 100 a month, 36 months, or whatever. They're 200 for 18 months, whatever the case may be. So that becomes a path. And we're seeing a lot of that. The nice thing about building a payer base is that it gives you, you start the month off with guaranteed revenue. So when you talk about diversification, right? You get the guaranteed revenue from first party because you know how many seats you need that month. You got a pretty good payer base. That's, somewhat guaranteed revenue. So now you put yourself in a revenue stabilization. You know, before the month starts, approximately what you got coming in. And the new revenue you create either by expanding, getting more seats on the first party side or the customer service side, or being successful campaigns digitally or old school way. That's how you build your revenue. And that's how you can, but you have to take a portion of that revenue, continue to invest in the technology. And you always got to invest more and more in technology. You got to, make your website better.
That I find interesting when you talk about the way that the consumers are behaving in terms of these longer term settlements is that consumers have become significantly more comfortable with subscriptions, and consumers are buying just about everything based on payments. I mean, look, you can even look at the buy now, pay later financing of like Uber Eats and DoorDash, which I I think is
Crazy.
irresponsible lending. I think it's
Yes.
irresponsible lending. However, I do notice that consumers are very focused on buying the payment these days. So if they can't make that $6,000 settlement payment and they can't pay you that balance in full right now, payments is where they tend to go. I don't know when the last time you
Absolutely.
went into a car dealership to buy a vehicle, but trying to get them to tell you the final price of the vehicle is probably the
It's
hardest
insane.
thing that I've done in the last year, because
It's
all they want to
insane.
talk to me about is my payment. I'm going, well, what's the interest rate on this loan? What is the final purchase price of this vehicle? Like, they don't want to talk about anything but the payment, which tells me that that's what the consumer is buying.
Yeah, I mean, I ask them for the money factor on the lease. They look at me like something wrong with me. Money factor means what's the interest rate? That's what it means because it's not free. But yeah, it is. And I lease cars because it's, as we all know, it's a depreciating asset. And what you're doing when you're buying a lease is you're basically paying off the depreciation. That's what you're doing. That's all you're doing. You're financing the depreciation. So, but you're right. Consumers are buying a payment. They're trying to find a number that can fit in their budget. Because they do want to, if you got a consumer that's willing to resolve it, they want to resolve it. The days of saying, well, just give me $50, $50 a month. And that's not effective anymore because that payer is going to break. He's just doing that to get you off the phone. What you really got to do, and that's why, as I said, the agents that remain are more highly skilled. They know they're going to be dealing with people or contact them that picked up the phone. So now they can go out and really negotiate a solid arrangement. And that's why, even though it's 28% of my employee base, it's 56% of my revenue. The third parties, the third parties, I'm not any way, shape, or form saying abandon third party. Third party pays the bills. But by having this diversification strategy, okay, you set yourself up for covering your fixed costs. And now the revenue generated from the third party not only contributes to the variable costs, but it also contributes to your margin. And that's what makes you a healthy company, is having that balance.
I would think it would be pretty significant. And as you've gone digital and as things have started to, your need for staffing has retracted on the third party side, you still have the infrastructure, the phones, the cubes, the office space, the facilities, the programs, the HR, right? Like all of those fixed costs that go with running that call center are
Right.
not
They're
going to
still there.
reduce significantly. So
No,
you'd
they're
still
not.
have this heavy, right? Like you'd still have
Yeah,
this
fixed
heavy
costs.
overhead fixed cost that you've got to manage.
Absolutely. No, I agree. And again,
So
that's again that they have this
moving it into a customer service aspect.
helps you cover that cost. I mean, you got to, more and more of our clients are requiring in office anyways. A lot of the issuers are pushing back. I mean, you come in the office, not all of them, thank goodness. So we're probably, it's a pretty good mix. It's maybe a 50-50 mix of in office and at home. The advantage at home, though, it allows you to expand your recruiting reach. We can recruit from Pennsylvania, recruit in Ohio, because it's lower minimum wage there. So our initial offer is attractive, and you can be $4 or $5 above the minimum wage. That helps you attract people. Now,
Well, and I think finding everybody in one geographic location has become more challenging, and that's been the
yeah,
push for organizations to do the work from home or to start leveraging BPO services and other, or opening offices in new geographic locations because
it's very
recruiting and
expensive.
retention has been very difficult. 88% of companies are having trouble hiring, 81% are having trouble retaining the people that they hire. And I think when we're talking about collections specifically, that number is probably higher than it would be if it was customer service based and the end user or the employee who's on the phone is under significantly less stress in a consumer customer service environment than they are in a third party debt collection.
Right. And the other nice thing of having first party collections is that as these agents become more and more skilled, some of them actually migrate back to third party because with in first party work, there's very little variable compensation, pretty much a desk fee. Some of our clients offer a small bonus based upon hitting certain KPIs. So that helps the agents. But a lot of these agents will migrate back to the third party world because, with some issuers, we do both. So as they become proficient in first party, they've been there for a while, they'll migrate into third party because they're already familiar with the product. And the good thing about, because we're using digital technology, because we're performing very well for our clients, we are expanding. We are getting more inventory based upon market share. I am actually hiring people in the third party stage. But again, I can draw from my first party people and backfill in first party, or I can just hire third party collectors. We are experiencing some growth, but again, I don't need to hire 20 people. Maybe I got to hire a dozen, half a dozen, because with 6 people, I can handle, 10, 15,000 accounts.
And what advice would you have for a creditor who's looking at expanding their relationship with an existing vendor? What advice would you give to them in terms of taking on that process, not from your perspective, but from your customer's perspective?
Well, I think it's easier for my customers. It really falls upon the vendor to inform the creditor of the additional capabilities that they have. I mean, you're already approved. I mean, all of us have been through creditor RFPs. They're no fun. And the sales cycle in creditor is minimally 12 to 18 months. You got an existing creditor. It's incumbent upon you to articulate to your creditor what their requirements are. But you got to look at what's the most important thing and it depends on the issuer, right? For some of these regional banks, I have some pretty large regional banks, mortgages is their bread and butter. Not only do they originate mortgages, but they service mortgages. So to be able to come into a system with mortgage servicing, mortgage collections. So within mortgage, you have different, just like the collection of different due stages, there's different events that occur. Obviously, you want to keep people current. So that's, first part of mortgage collections. But what happens after that is the whole foreclosure process. And they have a process they have to go through. And they have a thing called SPOC, single point of contact. And we do that work for one of the mortgage servicers, where you're actually communicating with people and you're trying to get them, hey, look, if you don't make this payment, we're going to have to look at either short sale or, foreclosure or some other things. So let's start this process. And sometimes it does lead to a short sale because, again, those are skill sets that banks require. But if you can provide it to a bank along with your mortgage collection capability, it just gives you value add. Again, the advice to third-party collection agencies, you've got the skill set. You know how to collect the money. You know how to handle inbound and outbound calls. You know how to be empathetic. Go talk to your issuers about working in other capacities. Again, they all outsourced a lot of these services. And that's what we did. We just went to our issuing clients and we took on. And another thing we do is episodic work.
Fair.
Episodic work is really tricky, but it's really
banks
lucrative.
Are built to lend money, underwrite that money, and service those loan accounts.
Right. But episodic work, they acquire another bank. Okay. Or they acquire a portfolio. They can't ramp up quickly enough. So you become their episodic partner. You hire people, you're going to charge them a premium for 90, 120 days. And you do that. So you go out and you recruit some people. And again, the nice thing about it is that the top performers, you keep into your own organization. The ones that don't perform that well or you just don't need anymore, then they go back into the temp field. You're going to be able to charge a significant premium for episodic work. And banks are always looking for people to do that work. We do a lot of work for banks in that aspect because they acquire somebody, they acquire a large portfolio. And it's simple things like welcome calls. Call up and welcome them to the new bank because they don't know who we are. Well, we're servicing your mortgage now. And by the way, do you want to set up automated payment? I mean, it's all the stuff we know how to do. So those are all the things that you can look at with your issuing clients. And they're willing to have those conversations. They have the need.
Well, Larry, it sounds like you've done an incredible job of taking a skill set or a craft in the individuals that you've developed in your organization and found new and interesting ways to deploy that craft to assist your clients in a variety of different ways. And I think that's the key to diversifying a collection agency in 2025 and beyond is finding those opportunities, leveraging those skill sets in new and interesting ways, and using it to drive revenue. I really like the way you talk about the cyclical cycles that some of the creditors are going through or different health insurance organizations are going through, and those seasonal needs and how you can start to close the gap on those seasonal needs and kind of find a nice ebb and flow for your own organization. But as always, Larry, I really do appreciate you coming on and sharing your insights with me today. Clearly been at this for a long time and you've been doing some great things and on the forefront of diversifying your collection agency. So I really thank you for coming on and sharing with me today.
Always enjoy talking to you. One of these days we got to get together in South Florida, though. We got to make that happen, my man.
For those of you that are watching, if you have additional questions you'd like to ask Larry or myself, you can leave those in the comments here on LinkedIn and YouTube, and we'll be responding to those. Or if you have additional topics you'd like to see us discuss.
Great talking to you as always, my man.
I look forward to it. If you see any other topics you'd like to have us discuss, you can leave those in the comments below as well. I think Larry and I are off a little bit on our digital sync at the moment here, but I'll get this cleaned up in post. But thank you everybody for watching today. We really do appreciate your time and attention. We'll see you all again soon. Bye, everyone.
Thanks again, everybody. Bye-bye.
I appreciate you, Larry.
Take care, brother. Talk to you soon.